Gold and silver markets are once again at the center of global financial attention as investors prepare for what could be a dramatic Monday opening. Over the past several weeks, volatility in the precious metals market has intensified, creating an atmosphere of uncertainty that has traders, analysts, and long-term investors watching every signal closely. Gold and silver have always served as barometers of economic fear and financial instability, and right now the world economy is sending mixed signals. Inflation concerns remain persistent, geopolitical tensions continue to simmer, and central banks across the globe are navigating one of the most complex monetary environments in decades. All of these factors are converging at the same time, and as the new trading week begins, one major question dominates the conversation. Will gold and silver crash? Or are they preparing for a massive rally that could shock the market? To understand what might happen when markets open on Monday, it is important to look at the recent price behavior of both metals. Gold has experienced strong upward momentum during the past year, reaching historically elevated price levels as investors sought protection against inflation, currency instability, and geopolitical uncertainty. At the same time, silver has demonstrated even greater volatility. Unlike gold, silver has a dual role in the global economy. It is not only a store of value but also a critical industrial metal used in electronics, solar panels, electric vehicles, and emerging technologies. Because of this dual demand, silver often moves more aggressively than gold, both upward and downward. When optimism about industrial demand increases, silver can surge quickly. But when market fear dominates, silver can also experience sudden corrections. The coming Monday could become an important turning point because several key forces are colliding simultaneously. One of the most influential factors is the strength of the US dollar. Historically, gold and silver tend to move inversely to the dollar. When the dollar strengthens, precious metals often face downward pressure because they become more expensive for international buyers. Over the last few trading sessions, the dollar has shown signs of strength as investors reacted to economic data and shifting expectations around interest rates. If this dollar strength continues into Monday, it could create downward pressure on gold and silver prices. However, currency markets can change quickly, and even a small reversal in the dollar could trigger a sudden rally in metals. Another crucial element influencing the market is interest rate expectations. Investors closely monitor signals from the Federal Reserve and other major central banks because higher interest rates typically reduce the appeal of non-yielding assets like gold and silver. When interest rates rise, investors can earn returns through bonds and savings instruments, which sometimes pulls capital away from precious metals. But the situation is more complicated right now. Inflation has remained stubborn in many parts of the world, and central banks are facing pressure from multiple directions. If investors begin to believe that interest rates will stabilize or even decline later this year, gold and silver could receive a powerful boost as safe haven assets regain popularity. Geopolitical tensions also continue to influence precious metals markets. Historically, periods of political instability, war risks, or international conflict have often driven investors toward gold and silver. These metals are widely viewed as financial insurance during uncertain times. Whenever global tensions rise, investors tend to seek assets that hold value even when traditional markets become unstable. Over the past few months, geopolitical developments have remained unpredictable, creating an environment where sudden news events can quickly shift market sentiment. If any unexpected geopolitical headlines appear over the weekend, Monday's market opening could see sharp movements in precious metals. At the same time, physical demand for gold remains strong in many parts of the world. Central banks have been steadily increasing their gold reserves over the past several years. Countries seeking to diversify away from traditional reserve currencies have increasingly turned to gold as a strategic asset. This trend has provided long-term support for gold prices and has created a structural foundation beneath the market. Even during periods of short-term corrections, this underlying demand can act as a stabilizing force. If prices dip temporarily, central bank buying and institutional demand often step in to absorb selling pressure. Silver's situation is even more complex because industrial demand plays such a large role in its price movements. The global push toward renewable energy technologies has dramatically increased the demand for silver. Solar panels, for example, require significant quantities of silver due to its superior electrical conductivity. As countries invest heavily in renewable energy infrastructure, the demand for silver continues to expand. Electric vehicles, high-performance electronics, and advanced semiconductor technologies also rely on silver components. This industrial demand means that silver's long-term outlook remains closely tied to technological growth and the global energy transition. However, despite these strong fundamentals, short-term market psychology can sometimes dominate price movements. Traders in modern financial markets react quickly to news headlines, economic reports, and technical signals. Large institutional investors often use algorithmic trading systems that respond instantly to market data. Because of this, markets can move rapidly in either direction, especially when key price levels are approached. As Monday approaches, many traders are watching important technical levels that could determine the next major move. If gold manages to hold above key support levels, it could attract buyers who believe the market is preparing for another upward breakout. In such a scenario, momentum traders may enter the market aggressively, pushing prices higher as they attempt to capture the next rally. Silver could follow this movement, but with even greater intensity due to its smaller market size and higher volatility. In past market cycles, silver has sometimes delivered dramatic percentage gains once bullish momentum begins. On the other hand, if selling pressure dominates during the early hours of Monday trading, gold and silver could experience a short-term correction. Such corrections are not unusual in long-term bull markets. Even strong upward trends often include periods of consolidation, where prices temporarily retreat before continuing higher. In fact, many experienced investors view corrections as healthy because they remove excessive speculation and allow the market to build a stronger foundation for future gains. Another factor that could influence Monday's market behavior is investor sentiment in broader financial markets. Stock markets around the world have experienced periods of both optimism and caution in recent months. When stock markets appear strong and stable, some investors reduce their holdings in safe haven assets like gold and silver. But when uncertainty increases in equities or bonds, precious metals often receive renewed attention. Because financial markets are deeply interconnected, shifts in one asset class can quickly influence another. Commodity markets also play a role in shaping precious metals sentiment. Energy prices, particularly oil, can affect inflation expectations and global economic outlooks. Rising energy costs often contribute to inflation concerns, which can increase interest in gold and silver as protective assets. Conversely, falling energy prices sometimes reduce inflation fears, potentially softening demand for precious metals. As traders analyze the weekend news and economic indicators, these interconnected factors will influence their decisions when markets reopen. Technical analysis is another tool widely used by traders attempting to predict market direction. Charts and historical price patterns often reveal areas where buying or selling pressure has previously emerged. Support levels represent price zones where buyers have historically stepped in to defend the market, while resistance levels mark areas where selling pressure has previously limited upward movement. As Monday approaches, traders will be watching these levels closely. If gold breaks above a major resistance level, it could trigger a wave of momentum buying. But if prices fall below a critical support level, automated trading systems might accelerate selling activity. Long-term investors often take a different perspective compared to short-term traders. Instead of focusing on daily fluctuations, they look at broader economic trends that could shape the market over many years. From this perspective, many analysts believe that the long-term outlook for both gold and silver remains positive. Global debt levels are historically high. Central banks continue to manage complex monetary policies, and economic uncertainty remains a persistent feature of the modern financial landscape. These conditions often create a supportive environment for precious metals over extended time horizons. For silver in particular, the supply and demand balance is becoming an increasingly important topic. Mining production has struggled to keep pace with rising industrial demand in some regions. When demand grows faster than supply, prices may eventually rise to encourage new production. However, developing new mining projects takes years, which means short-term supply shortages can occasionally occur. If industrial demand continues to expand while mining output remains constrained, silver could experience powerful price movements in the future. As traders prepare for Monday's opening bell, the mood across the market can best be described as cautious anticipation. Some investors believe that gold and silver are preparing for another major rally fueled by economic uncertainty and long-term demand. Others argue that recent price increases may have moved too quickly and that a temporary correction is likely before the next sustained move upward. Both perspectives have valid arguments, and the market itself will ultimately determine which direction becomes reality. What makes the upcoming trading session particularly interesting is the combination of technical signals, macroeconomic developments, and investor psychology all interacting at the same time. Markets often remain calm for extended periods before suddenly entering phases of intense volatility. These moments can create both opportunity and risk for investors who are actively participating in the market. For those watching from the sidelines, Monday's price action will provide valuable clues about the near-term direction of precious metals. A strong rally could reinforce the belief that the long-term bull market remains intact and that new highs may eventually emerge. A correction, on the other hand, might indicate that the market needs additional time to consolidate before the next major move. Ultimately, gold and silver have maintained their relevance for thousands of years because they serve fundamental roles in both finance and industry. Their value is influenced by human psychology, economic policy, technological demand, and geopolitical developments. These factors do not change overnight, which is why precious metals continue to attract attention from investors around the world. As the global trading week begins, millions of investors will be watching closely to see how markets react. Will gold and silver surge higher as investors seek safety and long-term value? Or will short-term pressures push prices lower before the next rally begins? The answer will begin to reveal itself when markets reopen, and the first trading hours of Monday could set the tone for the entire week ahead. For now, anticipation continues to build, and the precious metals market stands on the edge of what could become another dramatic chapter in its ongoing story.